Well, a very good morning, everybody, or it could be afternoon as you're listening to this, or even evening. So there you are, three options. I'm Darren, as you will know from my voice, and this is one of the sections that I will be presenting tomorrow at the Investors Masterclass. And I just thought it would be nice to record it for you as you've been unable to get down to Haverfordwest to Avalana House. So this update is something that I do every year. The theme this year has been all about good news. We're in such gloomy times, and so this section actually will finish the day off tomorrow and is probably the toughest section for me to deliver in a positive way because things have been so difficult for the last couple of years. Let's have a look together. So my mission at the Masterclass is to give our clients reasons to be cheerful. And there have been so many. They will have heard about many good things that the investment portfolios are doing, and also many positive outlooks within the markets. I would like to start by asking why bother? Why bother investing? This is just a simple chart. You can find all these sort of things on the internet if you look around. This one just literally shows how if you'd invested £100 back in 1899, now I wasn't around then, but that will show you over 120 years of growth. And you can see the green line is cash. That's money put in the bank and left alone for 120 years. Adjusted for inflation, it actually does grow and it comes in at around £500. But look at the other lines. You can see the orange and yellow lines. Those are the bonds. Those are UK gilts, UK bonds, and of course global bonds. And you can see that they come in around the £1,000 mark, so double the growth of cash. Interestingly, you can see how they've had a real rise in the last sort of 20 years, and then the recent fallback that was starting already at the end of 2021, and of course it's fallen further from there. But nonetheless, they have comfortably outperformed cash. Then you see the two big lines up there, blue and grey. These are the FTSE All Share, which is the UK index, all of them added together. And the grey line is the FTSE Global or FTSE World index, which is basically all the markets stuck together. So no fund management, just literally showing you markets and the growth there. It's just, you know, such an extreme example of why it's worth bothering, because historically you can see over a long time the FTSEs there coming in at sort of £80,000-90,000 growth, or £80,000-90,000 if left for 120 years, adjusted for inflation on a £100 investment. Now, let me be clear, I am not suggesting that we need a 120-year timeline, but what I'm trying to show is it is worth investing. This is what, you know, we have to go through to get there. Let's have a look at some other examples. Now, at the moment, things have felt really horrible, a real malaise. And I know that certainly some of our younger clients who haven't been with us very long, they will be starting to say now, oh, this has been 2 tough years, perhaps. Is it worth just calling it a day? Maybe going into cash. Things feel so hard. They're never going to get better. I know our more experienced clients who've been with us for some years, and certainly some of them for 20 years. They know these things come and go, but we have been through what we call a bear market. Now, just to be clear, a bull market is where markets rise by 20% from their base, and a bear market is where they fall from 20% from their peak. And we've been through this bear market, but what's really interesting is we've been through the longest bear market since 1948. And that really does show us that, you know, most of us won't have any kind of living memory of such a long malaise. It's felt like wading through treacle, but things are improving. Let's have a look at the next slide. I can show you what's going on. Now, this has been very kindly lent to us by JP Morgan. This shows you bull markets and bear markets running all the way back to about the late 1950s. And you can see at the top the green bull markets and look at them through the 60s, 70s, 80s. Big one then towards the end of the 90s into the noughties, then a huge drop off. Little one then 2003, and then again a much bigger one after the credit crunch. And what you can see underneath are the grey sort of shaded areas. These are the bears. Invariably what happens, and look, you can see this happens every single time. On the back of a bear, look how you then get a bull. And so you get this complete repetition, the bull, the bear, etc. Now, if we look at the bear market that came after 2008, if you follow that line along, you can see 03, 06, 09. Look at the gap in between the greens. So sort of 2007, there's that little cliff edge, bang, off it goes, and it drops into a horrible bear market. This was an absolute monster, 57% drop in markets, which is really, really a remarkable bear. The worst we've seen, and certainly the worst look here since the 1950s. But what's noticeable is that credit crunch, or the great financial crash as they called it, it sorted itself out. And within about 18 months, actually, just under 17 months, it's quoted here, things had recovered, and then the bull started again. And look at that long bull market that we all got rather used to. Things really went up and up. And in fact, it was very easy for anyone to appear to be an expert investor during these times. You couldn't really go wrong until the pandemic. And you can see in the pandemic a big drop, very sharp, the worst sell-off of all time, much, much faster than anything else, as in speed. So within days, once you unplug the global economy completely, as we did, you will see a massive drop, which is what happened, about a 34% drop, but it was so quick, like a needle look. But what's interesting is, as soon as the world realised, okay, there is a vaccine, this isn't going to be forever, markets bounced, and we had this lovely little bull that came on the back of it before entering yet another bear. And that's why this feels so depressing, is we remember the latest bear, not that far away, but it was a bit of a synthetic bear, I think is fair to say. It was caused synthetically and it was solved synthetically. What you've got now is a real bear, where you're seeing, war, inflation, supply chain issues, backlogs, all kinds of negativity, political wranglings, central banks doing things that we perhaps don't all agree with. And so you see a huge period of malaise. And this chart only runs actually through till sort of end of 2021, early 2022. So that bear had not finished by then, but you can see it right at the end of the chart, the grey shaded area. So we are now technically back out of that bear at last, but it's been a long one, folks. And that's why it's felt so horrible. Not the biggest sell down look, but a long one. There is some good news in all of this, because things have been sold off brutally. Now, I will be asking our attendees tomorrow to win prizes by guessing PE ratios. Now, what is a PE ratio? Well, when we look at the value of something, we might well look at its price to earnings ratio. And the price to earnings is basically, how long have I got to wait to get my dividends in that will enable me to have paid myself back for my investment? So, if I were to pay £10 for a share and that company was paying me £1 a year in dividends, then it would follow that I would be waiting 10 years to get my money back. So my PE ratio would be a PE ratio of 10. Now you can see on this chart, this is the UK All Share Index. You can see right back in 2003 time, UK shares were trading at very, very high PE ratios, 22, 23, extremely high. That meant you had to wait well over 20 years on average to get your money back through dividends on shares. More recently, if we go to 2021, when we had a nice little bull market, very short but nice, you were looking at 16 times PE ratios, which was really, really, an improvement for UK shares. It showed that they were quite desirable again. And then we see it go off the cliff edge. And this is really, really actually very exciting news for you and me as investors, because what we're looking at here is the January sales. We're looking at PE ratios that are back down and around the 10 mark, very, very low. we know that that shows us we are not in a bubble. And that's very, very important. It shows us that things are really, really depressed in valuations. Now, I know the news will be telling us all about the housing market, but that's very, very different to the stock market. The stock market's well ahead and it's reading this. Now, I wonder if any of you can remember a fantastic Sunday afternoon programme I used to enjoy as a child, although I was no good at darts. In there, there was a little Bully the Beef character. So this is the game I'm referring to. It was called Bullseye, and I wonder if you remember it. And the man on it, I can't remember his name. He was a very warm man. He would say, if they lost, he'd say, just look what you could have won. And he'd say this, and there'd be sort of, you could have had a holiday and a Ferrari and goodness knows what. But as it is, you've got this little Bully Beef character. And I always used to think it was a bit cruel, really. But at least it was only what they could have won. I'd like us to think about what we could have lost, because the last couple of years has been really hard. But do you know what? It could have been so much worse. And here's an example. We used to be invested into the L&G Gilt Tracker, a very good fund, still a good fund. It's not a managed fund, it's just a tracker, low charges, tracks the gilt index. And you can see here, according to Financial Express data, a turquoise line, which is the L&G gilt line, over the last year. Now, we looked at this fund. We had it sort of throughout 2008 and 9 as gilts became very, very prevalent, and we could see that these were valuable. And eventually we came out of it. And the reason we came out of it for our clients' portfolios, some of you will remember having it in your level 1 and level 2 portfolios. The reason we came out of it was because when we did our modified duration calculations ourselves here in the office, we were scared because they were showing us that, according to our reckoning, that if we had a 1% interest rate rise, we would see 8% losses on gilts. And so we went to various fund houses, Rathbones, JP Morgan and Saracen and so on. We spoke to these people and we said, look, what do you think? Are we right here? And their view was, well, actually, you're probably being a bit kind. It could be even worse. But the general thought at the time was, when interest rates were, 0.5%, 0.25%, well, surely interest rates won't go up that much. I mean, they'll never go up 2%, right? Well, of course, that's happened. So anyway, we were scared of that risk and we pulled our clients from it. And that doesn't make us magicians. It just means we're diligent and we did our job. The point is that it was very, very easy to miss this because the textbooks will tell you that gilts are the most cautious investments. This is supposed to be the most cautious investment, yet look at it. The poor thing lost 29.1% last year, and more worryingly, has lost over half its value in 3 years. Now, I'm sure it will come back, but the point is the journey would have been that much bumpier for our level 1 and 2 clients had we left this in the portfolios. Now, of course, it still has an impact, and the whole of the bond market is affected by gilts. And so if gilts have fallen this hard, it's very, very difficult to make any money with bond funds right now. But where we're at is we're celebrating perhaps 5% losses rather than 29% losses over this year. And that means we're in a much better position to know that our clients come back very, very quickly. And of course, because we diversify, we know there's other things in the portfolios which is growing. So that's positive. So there you are. Look what you could have lost. Anyway, let's move on. Now, this isn't a Rubik's Cube. It's my Morningstar chart that I've pinched. And at first it looks confusing, but it actually makes perfect sense. This is 20 years of history using some sort of 6 different asset classes: cash, fixed income, UK shares, international shares, emerging market shares. And look at what is so obvious. The highest performer, so the top of the pops, each year is usually different. Now, emerging markets can sometimes get that double whammy. And the reason behind that is emerging markets are often very linked to dollar strength or dollar weakness in the US. And you can see a bit of a repetition. But generally speaking, look how anyone that wins then loses. And so you get this kind of great year, then a fall. And cash, you can see, rocks along the bottom more than it gets towards the top, or it sits there, not doing much. Now, my point is this. We are coming across people who would like to come to us as clients, and their sort of comments are, well, I'm only going to really invest now in UK FTSE 100 because the FTSE's where money was made last year. Or, well, I'm only going to put it in cash because I can make money in cash, and I'll wait until things come back before I put it back in. The problem is, if you look at 2021 on that line, near the end, look at the second best performer there, it's UK shares. As you go into 2022, it stayed there, the second best performer. Cash, the best performer. But the point is, it's very, very unlikely that that will continue in 2023. Very unlikely indeed. And you can see how everything tends to fall away. And in fact, the worst thing, statistically speaking, you can do is put all your money on the one horse that's just won, because it's very unlikely that it will win again, as everything moves in cycles. Let's have a look at another similar chart. This is borrowed from JP Morgan. It's another Rubik's Cube. This one expands things out. They use slightly different names. They're looking at more markets rather than sectors. But look at that. It's such a similar story over the last 10 years. It gets back to 2014, but it pulls a 10-year annualized return across as well. Look how the S&P 500, that's the US stock market, or one of them, look how that tops quite a lot over the last 10 years. But look at how it can have, look at 2017, an absolutely bad year compared to everything else, if you like. It falls back a bit in performance. Two lots of numbers there, folks. One of them is hedged with currency, one of them isn't. Don't worry too much about that. The point is, look how things change. Now, go to 2022. This time they've removed cash. They don't see cash as needed in this slide, and I'd agree. Look how the FTSE is top. Everything else minused out in 2022. Your investor would be very forgiven for thinking at the end of 2022, I am going to now go only into the FTSE. But look what happens next in the first quarter of 2023. That blue box falls quite considerably against other markets, and so he's now left looking at better performance that he could have had. The other thing I'd like to draw your eye to here, if I might, is the grey portfolio box. Look how the grey portfolio box sort of floats just above average all the way through. It doesn't rock around in the same way. All right, 2020 it had a bit of an off year, but it's far, far more likely to be just above that average. What is portfolio? Well, JP Morgan have they've not used any kind of efficient frontier planning. They've not used any clever fund management selection as we would do, or any kind of back testing that we would do. All they've done is literally glued together a bit of this, a bit of that, and a bit of the other. And they've just literally taken a bit of each sector or market, glued it together and thrown it into the mix. And what is fascinating is that it does better than trying to pick this year's winner. So it's very important to see here and should give you some reassurance. The other thing I've pinched from dear old JP Morgan this year is what they predict markets might grow by. Now, this is really, really encouraging because things have felt really gloomy over the last couple of years, I know. But look at what they're projecting over the next 10 to 15 years. Now, let's just be, honest about this. This will not happen exactly as they're predicting because life isn't like that. But what they've done is they've pulled together all their economic data and all their numbers, and they have put together their best guess of what they believe, respectively, these markets might perform by. And you've got China here with expected annualized returns of 10% over the next 10 to 15 years. That means 10% per year expected growth. Coming down, you can see Japan, about 8.5%. Emerging markets, just over 8%. The UK, just over 7% per year. The US, just over 6%. Even those beleaguered gilts and bonds, coming in kind of around the 4 mark. Cash, 2%, 2.2%, 2.3%. It shows you where things may well be going. Now, of course, we can't predict everything, but JP Morgan, I trust them on this, and I think that it gives us, again, a little bit of warming in the soul to know that there is really a chance here for some great growth going forward. Now, as I start to head towards the end of my presentation, I wanted to show you this. I want you to imagine a new investor, and we're seeing quite a few of them at the moment. They don't have the experience that you have. They haven't been through the 5, 10, 15 years of seeing the ups and downs. And I want you to imagine that they've put their cash into an ISA, and they've popped it in here on the MSCI World Index on a tracker. So they haven't gone for fund management that we would look at. They haven't gone for a carefully blended portfolio as we would do. They've just gone straight onto a global tracker. So they're getting lots of different countries all in one place, one price, and here we go. So they put the money in at the beginning of that blue line, down in the bottom left of your screen, and it falls. And so they panic and they take the money out and they pop it in cash and they say, well, at least I can get some interest here. And then they see how it goes up, but they think, well, it won't keep going up. And lo and behold, it drops a little bit. And so they tell everybody down at the Bowls Club and, in Lidl and everywhere else that how clever they were, because they got out in time before this terrible crash that they think is going to happen comes. Then it recovers a little, and you can see on the digits along the bottom, 7, 14, 21, and look how it goes up. Eventually, when it gets to 21, they're feeling a little bit worried, a bit sick. They've got what we like to call FOMO, fear of missing out. And so they plunge back in to the market, only to find a few days later that it crunches down again, and they panic. And they feel terribly worried because they're hearing the news and they've got a mate who works in London. And anyone who works in London must know what's going on, right? And so they get out again and they go back into cash and they lose more money. They watch it go up, feeling sick, but they keep telling everyone it's going to crash, and it does. Down it comes, flying down, and they feel rather smug until it starts to go back up again. You get my theory. They go in, they go out. They lose, they lose, they lose. And the reason is you just can't predict where the good days are going to be. Now, this is just 3 months of good and bad days. Imagine if I could take this out over 24 years and show you the good and the bad days. Well, I can't do that. What I can do is give you a little bit of an example that Saracen very kindly came up with for us, and I've put into a fun question time. So here we go. Here's your question. If our investor put £10,000 in that MSCI index on the 31st of December 1998 and they left it invested for 24 years, how much profit would they make if they just left it to go up and down, move around? How much do you think they would make? Are you ready? Have you got your number? Let's see if you were close. Well, the number is £37,653 of potential profit here that they would have made if they just left it invested. Okay, let's say now that they decided to take the money out on some of the occasions where they got a bit panicky. They missed then some of the recovery, because the only way you're going to know when to get back in is after it started going up, right? So if you miss the best 25 days. Now, just to be clear, 24 years, according to my calculations, is 8,760 days. So you're invested for 8,760 days, but for 25 of them, you're out the market because for whatever reason, you had a panic or whatever. What's the difference in the growth? Do you make more or do you make less? I wonder. What do you think? I wish I had some kind of really clever ding, 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 but I haven't. Anyway, so how much did it grow by with just 25 days removed? Well, the answer is a measly £3,582. So over 24 years, your 10,000's become 13,000 just through missing 25 days out of 8,760. That is fascinating. So finally, just to ask ourselves, is it still worth it? Well, here's a real life example. This is our Pro Ethical 3 portfolio. We've been talking to ethical clients. This is what the Good News Masterclass has been about this time. And so we picked the medium risk of that. And you can see a U-Scan report, which is independent. We can't change it. And it just shows you the level 3 ethical portfolio running against a FTSE 100 tracker. Now, the FTSE 100 has had a really good run, and in fact, over 10 years, the FTSE's made 67%. But the Pro Ethical 3, which is supposed to be broadly as volatile, has managed to make 94.8%, even without oil and gas and arms dealing and so on. Now, this is quite important, and if you look at the lines, you can see in recent times how the ethical really struggled. You can see the ethical pulling away in 2020, going way up on the FTSE, and then just at the end of 21, crunching down whilst the FTSE continued to rise. Why? Well, war in Ukraine, inflation, oil and gas did well, arms dealers did well, tobacco did well. None of those are in the ethical portfolio. People forgot about the sort of, shall we say, the more meaningful, impactful investment, and so things fell. But you can see more recently, in the last couple of months, look, a divergence. It's far too early for me. And you can see how the FTSE 100, the red line, is falling down, look, right at the end of that chart, whilst the Pro Ethical 3 is starting to pull back away again. Why? I do believe we're entering a little bit more normal times, if possible. So there are some really good signs here. It is still worth investing, although, yes, most certainly it's been tougher of late. And in fact, look, in all honesty, you can see how over the last year, that portfolio is up nicely, about 8%, but over 2 years, it's still down by about 7%. And that's just because of the bad falls that happened last year. More importantly, though, if you hang on in and you see it running through 3 years, 5 years, and then the 10 years, it's definitely very rewarding. And it doesn't take much of your maths to work out your annualized return will be very respectable indeed over the 10 years that have passed. Now, of course, there's no guarantee that the next 10 years will be the same. We know that. But the best we've got is to look at history and to give ourselves some reassurance that despite nasty crashes and very, very tough recent times, performance has still been very, very encouraging indeed. So there's my investment risk warnings. I'd like to leave you with one last video, which is very short, and it just shows you our recent beach clean to give you a smile in case you missed it. It's about 1 minute long, I think. So I hope you enjoy it. And thank you so much for attending my online masterclass. And as always, we're always here if you need us. So please just let us know if you need anything at all.